Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
If you're a college student who's been growing an investment portfolio, good for you, or the parent of a budding investor, the Kiddie Tax is an important concept to understand. Under the Kiddie Tax, a dependent's unearned income can be taxed at the parent's higher marginal tax rate. The result can be some surprisingly high tax bills come April, to say the least. So on today's College Investor Audio Show, we tackle what you need to know about the Kiddie Tax rate, even if you don't consider yourself a kiddie. So what is the Kiddie Tax? Now, the Kiddie Tax is officially called the tax on a child's investment in other unearned income. I'm so glad they changed the name. It is the tax that a minor has to pay on unearned income, including investment income or other types of income. Prior to 1986, the year the Kiddie Tax was introduced, parents could shelter their investment income from higher tax rates by shifting assets into their minor children's name. The Kiddie Tax is designed to stop parents from giving large gifts to their children, only to have their children realize gains at a much lower tax rate. Under the Kiddie Tax rule, the first $1,100 of a child's unearned income qualifies for the standard deduction. The next $1,100 is taxed at the child's income tax rate. A child or young adult's unearned income beyond $2,200 is taxed at the parent's normal tax rate. There was a period of time, from 2018 to 2019, where dependents subject to the Kiddie Tax rules could have been taxed at rates higher than their parents' marginal tax rate. What? This so-called bracket climbing was the result of the Tax Reform Law and Tax Cuts and Jobs Act of 2017. However, the Secure Act of 2019 overturned the bracket climbing rules and restored the Kiddie Tax rules, similar to the 1986 tax reform. Phew! So what counts as unearned income under the Kiddie Tax? The Kiddie Tax rule only applies to unearned income. Income from a W-2 job or freelancing, maybe running a business, that's all earned income. Normal income tax rules apply to that type of income, but as a dependent, your standard tax deduction is the lesser of $1,100 or your earned income plus $350. Example, if you earned $7,200 from your part-time job, your standard deduction will be $7,550. That means your tax rate on earned income will be 0%. Unearned income includes interest, dividends, capital gains, rental income, taxable scholarships, and other types of income produced from assets that a minor, under the age of 18, or a full-time student, under age 24, owns. Capital gains from a 529 plan do not qualify as unearned income, because gains in these accounts are tax-free, of course. Who does the Kiddie Tax apply to? A dependent is anyone who isn't required to file their own tax return. The Kiddie Tax rule apply to the following types of dependents: kids under 18 at the end of the tax year, adults age 18 at the end of the tax year who didn't earn income that was more than half of their support, full-time students 19 to 23 who didn't have earned income that was more than half of their support. Under the Kiddie Tax rule, unearned income less than $2,200 will be taxed at their own tax rate, but income beyond $2,200 is taxed at the parent's rate. Why does the Kiddie Tax matter to college investors? If you're currently a student looking to make some money through investing, you might be in for a surprise come tax time. The marginal tax rate on ordinary unearned income, such as rental income, ranges from 10% to 37%. That's a big range. But the rate you'll pay on income beyond $2,200 is your parent's marginal tax rate, not your own marginal tax rate. The marginal tax rate on qualified dividends and long-term capital gains ranges from 0 to 20%. If you're a higher earning student, you and your parents may pay less taxes overall by filing your own tax return. To file your own return, you must earn at least enough money to provide half your support and claim yourself on your own tax return. Now, how can you file the Kiddie Tax? If you have unearned income beyond $2,200 per year, that's pretty amazing for young investors. Great job. If you made less than $2,200 in unearned income, your parents will likely want to continue to claim you as a dependent. Information about a dependent's unearned income is filed through Federal Form 8615. All the major filing tax software programs support this form. The programs will automatically minimize taxes on your unearned income. Thank you, software. Dependents who made more than $2,200 in unearned income but do not qualify to file their own tax returns will also need to file Form 8615. The tax software programs will calculate the amount due based on your parents' marginal tax rate. I hope that helped to clear things up on the Kiddie Tax. Now, if you have any questions about this, you want to see more resources and just more information in general, check out thecollegeinvestor.com. And you are a college investor, so why wouldn't you be checking it out anyway? Thanks again for stopping by today, and we'll talk to you again very soon.